Every financial crisis in the last 100 years ended the same way. The banks got bailed out, the savers got squeezed, and a specific group of people came out the other side wealthier than when they went in. 1929, 1971, 2008, and 2020. Every single time. And here is the question that most financial content never asks out loud. Is that a coincidence? Because across this series, we have shown you that your bank deposit is not legally yours, and that the Federal Reserve was designed in secret by the banks it was supposed to regulate. That the same institutions own the money system, profit from its crises, and have quietly built the infrastructure to replace it when the time comes. Every one of those claims came with names, dates, documents, court rulings, and congressional testimony. None of it was speculation. So now we are ready for the question that connects all of it into a single answer. Was any of this an accident? And the answer, documented, named, and verifiable, is more unsettling than any conspiracy theory could be. Because it does not require a secret room or a shadowy cabal to be true. Did the Federal Reserve end up privately owned by the banks it regulates by coincidence? Did the same financial families just happen to be positioned correctly for every major crisis of the last century? Did the system that systematically transfers wealth from savers to asset owners just happen to evolve that way without anyone designing it? Or is there something more deliberate underneath all of it? By the end of this video, you will have the answer. Not a theory and not a speculation. The documented, verifiable, named answer that the evidence actually points to. And it is more unsettling than any conspiracy theory, because it does not require a secret room or a shadowy cabal to be true. To answer whether this was an accident, you first need to understand the institutions that exist specifically to coordinate financial policy across national borders. Because most people have never heard of them, and their existence alone answers a significant part of the question. The Bank for International Settlements was established in Basel, Switzerland in 1930. Its stated purpose was to facilitate reparations payments from Germany after the First World War. Its actual function, which it has performed continuously for almost 100 years, is to serve as the central bank for central banks. It is the institution where the governors of the world's most powerful central banks meet, coordinate, and align their policies. The BIS is not a government institution. It is not accountable to any electorate. Its meetings are private. Its decisions are not published. Its membership includes the Federal Reserve, the Bank of England, the European Central Bank, the Bank of Japan, and the central banks of every major economy on Earth. When the Federal Reserve decides to raise interest rates, the Bank of England decides to hold, and the European Central Bank decides to cut. Those decisions do not happen in isolation. They happen in the context of ongoing coordination through the BIS, that ensures the global financial system moves in ways that serve the collective interests of its member institutions. This is not speculation. The BIS publishes its own history. Its coordination function is openly acknowledged. What is not openly acknowledged is the degree to which that coordination shapes outcomes that affect every person on Earth who holds a bank account, pays a mortgage, or receives a salary. Then there is the Council on Foreign Relations, established in New York in 1921, 1 year after the Federal Reserve had bedded in. The CFR describes itself as an independent, non-partisan think tank. Its membership has included virtually every U.S. Secretary of State, Treasury Secretary, and Federal Reserve Chairman since its founding, and its publications shape the policy consensus that both political parties draw from, regardless of which one holds power. The CFR is not a secret organization. Its membership list is public, and its publications are available to anyone. But its function, creating and maintaining a policy consensus among the financial, political, and media elite that transcends electoral cycles, is rarely examined directly in mainstream discourse. And then there is the institution that most explicitly embodies the question this video is asking. The Bilderberg Group has met annually since 1954. Its attendees include heads of state, central bank governors, CEOs of the world's largest financial institutions, senior military officials, and media executives. Its meetings are held in private. No press is admitted, and no minutes are published. No official record of what is discussed exists. The Bilderberg Group does not make decisions, or at least that is what its organizers consistently state. It is described as a forum for informal discussion between influential people. But a forum where the people who set interest rates, run the largest banks, control major media organizations, and lead national governments meet annually in private, and where the outcomes of those informal discussions are never disclosed, is not a neutral social gathering. Its existence is not a theory. It is documented, and it has a website. It publishes its attendee list each year. The question is not whether it exists. The question is what a meeting of that specific combination of people, held in private, every year for 70 years, actually produces. If the institutions exist to coordinate, and they demonstrably do, the next question is whether that coordination has produced outcomes that consistently benefit specific interests at the expense of ordinary people. Because coordination is not the same as conspiracy. The question is what the coordination has actually delivered. Let's look at 3 specific moments where the pattern is clearest. The first is 1971. When Nixon closed the gold window and ended the Bretton Woods system, he did not make that decision alone or spontaneously. The decision had been prepared over years of coordination between the US Treasury, the Federal Reserve, and key allied central banks. The specific timing, a Sunday evening announcement designed to prevent markets from reacting before the decision was irreversible, was chosen deliberately. The outcome? A global monetary system where the dollar was backed by nothing except American military and economic power was not an accident. It was a designed transition from one system to another that happened to dramatically increase the flexibility of the United States government and the Federal Reserve to create money without the constraint of gold convertibility. Who benefited? Financial institutions whose assets were denominated in dollars, and who could now operate in a system with no hard constraint on money creation. Who bore the cost? Every ordinary person whose savings were denominated in a currency that could now be inflated without limit. The second moment is 1999. The Glass-Steagall Act had separated commercial banking from investment banking since 1933. A direct response to the conflicts of interest that had contributed to the 1929 crash. For 66 years, it had prevented the largest banks from using ordinary depositors' money to fund speculative investment activity. In 1999, it was repealed. With the active lobbying of the largest financial institutions, the support of the Clinton Treasury Department, and virtually no public debate about what the consequences might be. 9 years later, those consequences arrived in the form of the 2008 financial crisis, the direct result of exactly the kind of speculative activity that Glass-Steagall had been designed to prevent. The banks that had lobbied hardest for the repeal were the primary beneficiaries of the subsequent bailout. The ordinary depositors whose money had been used to fund the speculation bore the losses through unemployment, foreclosure, and a decade of near-zero interest rates that destroyed the real returns on their savings. Was the Glass-Steagall repeal an accident? The lobbying records are public, and the campaign contributions are documented. The revolving door between the Treasury Department and Wall Street in the years surrounding the repeal is a matter of public record. You can call it corruption. You can call it regulatory capture. Or you can call it the predictable outcome of a system where the institutions being regulated have more influence over the regulatory process than the people being protected by it. But you cannot honestly call it accidental. The third moment is 2020. When the pandemic hit and markets crashed, the Federal Reserve created $3 trillion in new money in less than 3 months. The primary mechanism for distributing that money was the purchase of financial assets, bonds, mortgage-backed securities, and, for the first time in history, corporate debt. The immediate and direct beneficiaries were the holders of those assets, overwhelmingly the wealthiest individuals and institutions in the economy. The Federal Reserve did not accidentally choose a mechanism that disproportionately benefited asset owners. It chose the specific tools it had available, tools that had been developed, tested, and refined over decades of coordination through the BIS and other international financial institutions. The outcome was not a surprise to anyone who understood how those tools worked. It was the predictable result of applying a specific set of instruments designed by and for the institutions that hold financial assets. One of the most consistently documented mechanisms through which the system perpetuates itself is so mundane and so openly acknowledged that most people never recognize how significant it is. The revolving door between government financial regulation and private financial institutions has operated continuously for over a century. The people who design financial regulation move between government positions and private sector roles with a consistency that makes the distinction between regulator and regulated almost theoretical. Hank Paulson was CEO of Goldman Sachs before becoming Treasury Secretary in 2006. 2 years before the financial crisis that Goldman Sachs survived largely because of Treasury Department decisions. Timothy Geithner was president of the New York Federal Reserve, the institution owned by the largest private banks, before becoming Treasury Secretary in 2009 and overseeing the bailout of those same banks. Robert Rubin was co-chairman of Goldman Sachs before becoming Treasury Secretary, after which he joined the board of Citigroup, one of the primary beneficiaries of the deregulation his Treasury Department had championed. These are not isolated examples. They are the norm, and they represent a personnel pipeline between the institutions that benefit from financial policy and the institutions that set it that has operated with remarkable consistency across administrations of both parties for decades. This pipeline does not require coordination in any conspiratorial sense. It does not require anyone to make an explicit agreement to serve private interests at public expense. It simply requires that the people making regulatory decisions are people whose entire professional formation, whose networks, whose assumptions, whose understanding of how the world works, was shaped inside the institutions they are now nominally regulating. The result is a system that produces outcomes consistent with the interests of large financial institutions, not because anyone is directing it to, but because the people running it genuinely believe that what is good for large financial institutions is good for the economy as a whole. That belief is not cynical. It is sincere, and it is the most powerful perpetuation mechanism the system possesses, because it requires no conspiracy to maintain. We can now answer the question this video has been building toward. The honest answer is, it depends on what you mean by accident. If you mean, did a group of people sit in a room and deliberately design a global financial system specifically to transfer wealth from ordinary people to financial elites? The evidence does not support that conclusion cleanly. The system is too large, too complex, and too distributed across too many institutions and too many countries over too many decades to be the product of a single coordinated plan. But if you mean, did the system evolve accidentally, without intention, without design, without specific people making specific decisions that consistently and predictably served specific interests, the evidence does not support that conclusion either. What the evidence actually shows is something more nuanced and in many ways more difficult to address than either a clean conspiracy or a clean accident. The system was designed in specific moments by specific people making specific decisions in ways that consistently favored the institutions those people came from, returned to, and whose networks shaped their understanding of what good policy looked like. Jekyll Island was not an accident. The Federal Reserve Act was not an accident, and the repeal of Glass-Steagall was not an accident. The specific mechanisms chosen for the 2008 and 2020 bailouts were not accidents. The composition of the BIS, the CFR, and the Bilderberg Group is not an accident. None of these things required a master plan. They required something much simpler and much harder to reform: a consistent alignment of interests between the people making decisions and the institutions benefiting from those decisions, sustained across generations through the revolving door, the educational pipeline, and the simple human tendency to design systems that work well for people like yourself. The philosopher and historian Carroll Quigley, who had access to the private papers of some of the key figures in this history, wrote in his 1966 book, Tragedy and Hope, that there does exist a network of financial influence whose goal is to create a world system of financial control in private hands, able to dominate the political system of each country. He was not a fringe figure. He was a professor at Georgetown University and a mentor to Bill Clinton, who cited him in his presidential nomination acceptance speech. Quigley's insight was not that the network was malevolent. It was that it existed, that it was largely invisible to the public, and that its existence explained patterns in financial and political history that were otherwise inexplicable as coincidence. So here is where 6 videos of evidence leave us. The system was not an accident. It was not a conspiracy in the Hollywood sense. It was something more mundane and more durable than either of those things. A self-perpetuating alignment of interests between the people who design financial systems and the institutions that benefit from them, sustained across generations by the revolving door, the coordination institutions, and the simple fact that power tends to design systems that perpetuate power. Understanding this does not make you a conspiracy theorist. It makes you historically literate. Every major historian of financial systems, from Quigley to Charles Kindleberger to Adam Tooze, has documented versions of this pattern in their work. It is not fringe. It is the mainstream of serious financial history. And understanding it changes something specific about how you navigate the world. When the Federal Reserve raises interest rates and your mortgage payment increases, you now understand that decision was made by an institution owned by the banks that benefit from higher rates, not by a neutral public body acting in your interest. When a financial crisis is resolved through mechanisms that bail out asset holders while ordinary savers receive near-zero interest rates for a decade, you now understand that outcome was not the only option available. It was the option chosen by people whose professional formation took place inside the institutions that benefited from it. When the same financial families appear on the right side of every major crisis, positioned in gold before currency collapses, in assets before bailouts, in alternative systems before reserve currency transitions, you now understand that positioning is not luck. It is the natural result of having access to the coordination mechanisms and institutional relationships that ordinary people are never offered. None of this means the system is about to collapse, and none of this means you should make dramatic financial decisions based on fear. None of this is a prediction or a recommendation. It is simply the framework that the evidence points to when you follow it honestly and without the comfortable assumption that the system was designed to serve you. What you do with that framework is your decision, but you now have it. Was any of this an accident? The Federal Reserve, privately owned by the banks it regulates, not an accident. The revolving door between Wall Street and the Treasury Department, operating continuously for a century. Not an accident. The coordination institutions, the BIS, the CFR, the Bilderberg Group, meeting privately, annually, with the people who set interest rates and run the largest banks. Not an accident. The consistent pattern of financial crises resolved in ways that transfer wealth from ordinary savers to asset holders. Not an accident. Not a conspiracy and not a master plan. Not a shadowy cabal directing history from a secret room. Something more mundane, more durable, and in many ways harder to change. A system designed by people who benefit from it, maintained by people who were formed inside it, and perpetuated by the simple human tendency to believe that what is good for the institutions you came from is good for everyone else. You now have the complete picture. 6 videos, 1 conclusion. The hidden rules behind money were not hidden by accident either. If this series has given you something most financial content refuses to provide, subscribe. Share it with one person who you think needs to see it. Because the most powerful thing this framework can do is spread to people who have never been given it. The system depends on most people never asking the question this series just answered. You asked it.